Hello and welcome back to the Strange Water podcast. Whether you're new to the pod or have been following for a while, thank you for tuning in. We've got a really great conversation for you today. A few weeks ago, I met Dan Ugolini from Rysk Finance while moderating a panel discussion on options. I've never been a big options guy. While I think their ability to express a wide variety of views on the market is interesting, my eyes start to glaze over the moment we begin talking about Greek letters. But here lies one of the most exciting parts about working in crypto. Even though I had very little interest in the mechanics or actually trading options, I found myself more and more fascinated by the larger conversation about building on Ethereum. Specifically, the way Dan spoke about composability and building smart, programmable options set my mind racing on what it means to build on the world computer. The following conversation is one of the best, most nuanced conversations I've had about the peculiarities of building on Ethereum in a long time. We cover the power of composability to unleash a community's creativity, the differences between developing in Web 2 versus Web 3, first principles on integrating third-party protocols, and so much more. Again, I am not an options person, but I am an Etherean. And after this conversation, I can confidently say that very few people get it, from the finance to the computer science and everything in between, better than Dan. One more thing before we begin. Please do not take financial advice from this or any podcast. Ethereum will change the world one day, but you can easily lose all of your money between now and then. All right, enough of me. Let's bring on Dan. Dan, thank you so much for joining the podcast. Great to have you.
Yeah, no, thanks for having me. That's going to be exciting. So great to be here.
Yeah, so before we start getting like real big brain and talk about like the future of finance and composability and all that stuff, we got to start with what brought you here and what brought you into crypto. And I'm like a huge believer that you don't find yourself on the outside of like the global financial system without a story or a reason. So Dan, what brought you to crypto?
Yeah, let's start with that. That's actually a good point. So I started my career was doing investment banking. So, like real financial stuff. And I was working in the M&A corporate banking. So, very institutional. And to be honest, I loved finance per se, like as a, the way of actually financing projects and stuff like that. What I didn't like was all the bureaucracy. So I started was like 2012 or 2013, something like that. So right after, the big crisis, and the whole job was like huge bureaucracy, like everything was an internal committee and stuff like that. And so I quit that and I wanted to work in something more, exciting, if I can call it that way, even though, I loved finance per se. And I started to actually learn programming because I wanted to work in tech. And I was like, if I work in tech, I need to have an understanding of what's going on behind the product, right? So I started to learn coding, take some time off, and I actually moved to Berlin back then. And that was actually the first time where I heard about Ethereum. I remember like going to meetups, and the Gnosis team, for example, was I think one of the first one in Berlin. I'm talking about like 2016, 2015. And so I was like, oh, this is actually exciting. I knew about Bitcoin already, and I found Bitcoin, super cool and whatever, but I couldn't find anything exciting except buying it and holding it and waiting for price to go up. Like this was pretty much everything about Bitcoin for me. It's like I never paid a friend with Bitcoin or something like that. But when Ethereum came out, I was like, oh, this is actually exciting because we can build products and stuff. So back then I was actually working on my own project, and it wasn't crypto related, not even finance. I was doing online education, software as a service. I have my own company. And so in the spare time, I was always, excited about crypto. So the job was working on my stuff, building a lot of like backend and full stack work. But in the meantime, looking into, crypto. And at the beginning, like even with Ethereum, I got pretty excited, all the ICO area. I was like, okay, this is getting like something interesting, if you can call it that way. but yeah, I don't really know, what's going on. And I remember like most of this SEO, I was like, okay, this is just a good way to lose a lot of money. That's what is going on, right? But I remember actually finding some nice projects back then. And I was like, okay, this is actually interesting. Like the first one obviously was Aave, Eatland. It wasn't even Aave back then. And so I remember like going in 2019, for example, to some hackathons. I remember one organized by Consensus, one in Paris, meeting, like all those OG teams. And I was like, okay, this is actually exciting because there is, a utilization of what we built in here. It's like, this is a new financial system. I remember like speaking with Stani, and it was like, we are building open finance. It wasn't even called DeFi back then.
During this time when like your 2016 2017 era when you're like really starting to realize there's something here, as you said, your background is like real finance and then like learning computer science. When you were seeing these new primitives and like talking to Stanley and stuff, like what what was like getting you like really pumped? Was it about like open finance and like this new like paradigm? Was it about distributed computing and like where computer science was going? Like was it just about the people and like the smartest people in the world were gathered around this? Like what did you see back then that like allowed you to take the plunge?
Yeah, no, I mean, back then, again, like at the beginning, I was more skeptical because I couldn't find like a utilization of those, ICOs, whatever. But when it was like 2018, 2019, like this idea of open finance, I mean, I still remember literally Stani being on stage and talking about open finance. I was like, wait, this is actually pretty cool because myself at this hackathon, I can basically build a product on top of, Aave or Itland back then, and I can create, a new financial product. And I was like, this is actually very exciting because I didn't mention that, but one of the first projects that I made myself when I was learning coding, it was actually a payment system. So the idea was I want to pay back my friends after a trip, right? Super simple. And I was in Italy back then, and there is no way that you can build, at least like in 2012, 2013, when I was, starting to get excited about coding, to build a product, financial product. Like it was completely closed system. There is no way that you can send money to someone else.
I mean, it was possible. Then you could just raise like $5 billion and be called Stripe.
Yeah, yeah, exactly. Or I remember looking in Italy, and I think I was talking about like 2013, 2014, and I was like, oh yeah, you need a banking license. I was like, okay, that's interesting. I was like, 5 million banking license. So when I was looking, like at this open presentation, I was like, wow, this is actually very exciting. Like in an hackathon, I can build a product. I can also use, those primitives, and I can actually create a lending market and everything on top of what we have. So that was probably the main thing that excited me the most. And the second one is like, I don't have to ask to anyone. I can just gonna build it. It's like that was simple as that, right? And so that was probably the trick that was like, okay, this is interesting. This is like a very new paradigm in what we're building in the space. So that was like the excitement phase.
Yeah, well, we did not plan this. This is supposed to be a talk about composability, and it turns out the thing that got you excited was composability and like censorship resistance. So we'll get there in a little bit, but please just continue with like your journey to 2023. So you're walking around, you see Stanley, he's like convincing you that like all you need to do is get interested, and then you can build finance. Like how? Just bring us from 2019 to here.
Yeah, 2019 to years. So 2020, that's the biggest point in time. I still had my company. I was working with, Web2 education and software. But COVID started, so there is a lockdown,
In
and
Italy too.
I
Jeez.
was in Milan, the worst place ever. So I couldn't even leave my house. Like I had police in front of it. I was like, okay, let me find something to do right now. And so I found I was using a lot of DeFi back then, and I started to get pretty excited about Open, the options protocol. And so I got in contact with the team, and I was like, "Yeah, I like your product." I had a couple of feedback, like kind of a contributor at the beginning. And then we became kind of very, friends and close. And so at some point they were like, hey, you have time because apparently there is this huge lockdown. You want to help us out. You have experience, in startups and everything. And so I started to basically work with them kind of part-time at the beginning. Very early on, I'm talking like Opin that just launched the first V1, and it was like, March or April 2020, something like that. And so that was the big moment when I actually started to be, way more involved, not just as a user, but more like on building and so on. And after that, after open, so I'm talking end of 2021, basically. Um, I was on the open Discord, and I found few people that eventually became my co-founders in the future, and we started to brainstorm some ideas for an hackathon. And the idea was to build something on top of open. So back again to composability. And the idea was, how can we build some sort of like liquidity layer on top of this primitive that it was the options element, right? So open was a element layer for options. So you can create any option using that protocol back then. And I was like, okay, let's try to build something on top of it, like similar to an AMM. And he started like an hackathon project and actually became Rysk. And since then, we're full time on it. So again, composability, that was the trigger at the beginning. Like I met those people and we done an hackathon to build something on top of open and use their composability. So again, that's what bring me to the space, I guess.
Man, very cool. Again, did not plan this, but so before we get to risk, so I think for like people in this industry who don't have experience with real finance, like finance is this like monolith in which like all financial things happen. And just like if you're a farmer, you grow food. Like if you're a financer, you do finance, right? Financier. And so for us that like have done real finance, like, oh my God, like finance is so varied in variety, right? You said you were working on M&A. Like I used to be working on treasury management. Like uh, the idea, well, especially for M&A, you were not like messing with options on a day-to-day basis. Like that's just not what M&A is. And so can you talk a little bit about like what drew you to like first open, but then like really like realize like that this whole space is like something that is worth your time?
Yeah, that's a good question. That's as you said, like options is something that you really don't use when you work in, finance in terms of like corporate finance or, as you said, treasury and so on.
The closest like example of when I would use options at Anheuser-Busch for treasury management is like we wouldn't use options, but we would use futures to like lock in production costs or something. But point is, it's like options are just like outside of the realm of like business operations, M&A, like all these kinds of things. So I just yeah, how did you get there?
For me, the closest thing to option was like stock options, right? It's not even like
Yeah,
something you
yeah.
trade. It's just like something they give you like when you join a company, especially when you do, startups and so on. But the thing for me is like about options. When I started as university, I got pretty excited about them, but I wasn't probably like I'm a bad trader. That's something like I'm honest in saying that I was like definitely not a good trader, or let's say that there are traders better than myself for sure. And so when I got excited about option, I was like, okay, I'm not gonna trade them anyway. So it's excitement. It's good to see like how the pricing moves and all the variables agrees, but you actually don't use it unless you trade them, right? But when I found open, I was like, oh wait, this is actually getting interesting because I can work with options, understand them, but I don't have to trade them, right? So I can build something on top of it, and even if I'm a bad trader, it's like I can play with it. And so I got very excited because working on building a protocol is actually makes you like you have to understand a lot about the instrument. You have to understand how people use it. You have to understand like everything behind all the risk and what could go wrong. But even if you're a bad trader as myself, you can still work on it because again, you don't have to trade, but you have to basically build something for people to actually trade, right? Um, and so when I started to basically create this liquidity layer on top of Open, actually like trading was involved. So because at the end of the game, like when you try to add liquidity, you have to make a lot of risk management. For example, you don't want people to lose money, liquidity providers. So again, you need to understand a lot about trading, risk, and everything. But that was probably on a second level. The first level that actually made me like interested was like options are cool, and that's the best way for me to get into it because again, I'm not enjoying trading a lot in my life, like in my daily life. I do like trading sometimes. I do like trading at options sometimes, but building option is actually way more exciting for me because probably I'm more on the building side. So again, that's what made me actually go very deep into options and everything. And that's how we build risk. By the way, we have very good traders in our team as well. We done a trading comp, our quant won the trading competition. So we have very good trades. So don't worry about it. I'm the guy making sure everything works. but I'm not the trader.
I have been wondering who the winner of that trading comp was, but now I know. So
It was our quant, but we didn't give him a prize because it was like, yo, you're from the team, like we cannot give you a prize. So it was our quant.
yeah, hey, listen, all I have to say is like you're more honest than like 99% of people in crypto because it's always your own quant that wins the competition. It's just no one ever tells you that.
Yeah, yeah, it is true, right? I mean, the thing is that we also try to, for example, we didn't tell him like when we release new product or something, so we didn't want him to win, and he won. So I was honest with him. I was like, "Yo, you really won. Actually, you good." I mean, we did everything to make sure you couldn't win, but yeah, it won.
Yeah. All right, we'll get to the trading comp in a sec because like there's a lot of interesting stuff to pick apart there. But while we're still doing this slow roll, so you're at open and like you're realizing like you're contributing, you're seeing what options are in DeFi, which like spoil alert, like meh, like whatever's there is not great, and like the reason it's not great is because like pricing is just so shot to shit that like it's not even worth buying. And so, can you talk a little like totally hear you that the origin story of Risk is like, oh, like hackathon, like build a liquidity layer on open and so, but just like taking a step back during this time before you start Risk, whether you're looking at open, Lyra, DopX, like the entire ecosystem, Deribit maybe even, the entire ecosystem of crypto options, like what are some of like the real like challenges and like things you are seeing that need to be overcome before this goes from like far out on the innovation curve and like something that's coming to like a real tool that like traders can trade, like hedgers can hedge, that kind of stuff.
Yeah, yeah, that's one of the, you know, biggest question and probably hardest challenge that we face in, on a daily basis. And when we started Risk was basically based on this. Like we figured out what were the issues back then, and we're talking like a market that was also very early. And it's like, how can we, make this product in a sense that we're gonna fix those problems, right? One of the main one when it comes to options in crypto, specifically, so not just DeFi, I'm talking about crypto in general. It's was the use case, right? So one thing about like using option, you mentioned some of the use case. Like the main one is actually obviously you want to get leverage or speculate on something, and you can get like very good leverage with options. The other one is hedging, right? So those are like probably the two main ones. There are more, but let's say those are the two main ones. On the hedging side, yeah, yeah, structured product is definitely, but even on the structured product, you have one goal at the end. Like it could fall in one of those categories. Like you could protect or you can basically create a structured product that is super degen. But yeah, let's say, hedging and speculation, the two main ones, and then let's say like income generation for a third category. But when it comes to hedging, crypto, it's a very weird industry when it comes to that. And we saw that by results, right? Like look at what happened in last year, and we realized that no one was actually hedging, no one was doing risk management, like not even the big players, right? So obviously I'm not saying that everyone is not doing it, but I'm saying it's one of those industry where it's way more profitable to just be delta one, and means like you're just gonna long any asset that get thousands of leverage and wait for the price to go up. That's how like most of the people and funds and so on made money in this space. Or and so that's one of the things, like who's gonna use actually those products when it comes to hedging. And right now, because of the actors that we had and everything, it was challenging to find those use cases. And so one thing, I guess, if we believe that crypto is gonna mature as an industry and we're gonna get more institutionals and we're gonna get more, advanced traders, pension funds, like all those, actors making real volumes, real money, an options market will be needed because options are still a very good instrument, especially when it comes for, hedging and protection. So if you look at the volumes right now, like even in something like that, a bit that is doing like 95% of the volumes when it comes to crypto options, um, they still have this target market that is mostly like crypto market makers or crypto, let's call it hedge funds. So it's still limited to this closed industry. But again, if we believe that this industry is gonna grow, and I definitely believe that myself, and being here for a long time, we believe the option space should be there. So that's one thing about when it comes to crypto option. But when it comes to speculation, so not just hedging, like, we said that everyone wants to get leverage and everything. Something very interesting about crypto market to me, it's how perpetual became so popular when it comes to leverage versus options, for example. So, FTX was doing, perpetual, but we have a lot of them in DeFi. GMX is definitely the big one. Like, how actually was better for options traders, sorry, for crypto traders that want to get speculation to actually use a perpetual instead of using options, right?
Just to help like the people at home who aren't like who didn't have TradFi experience before this, like a perpetual is actually called a perpetual futures contract, and it does not exist in the real world. Like it was invented by like Arthur Hayes, and I forget which exchange is his, but like this is what Dan is trying to say here is that like something weird happened in crypto where like the normal tool by which everyone does the exact same behavior was not created. Instead, we created this like very custom thing that really didn't exist before to do that same behavior. And so, anyway, I'll let you continue from there.
Yeah, no, that's correct. I mean, in traditional finance, we didn't have this perpetual future. So if we are like, no one was using it, but everyone was mostly using options or just futures, right? So the thing about perpetual futures is they made this type of leverage trading very easy. Like when you trade a perpetual, there is basically nothing that you have to do except of choosing what is your liquidation price at some point, and leverage you're gonna get, right? So you say, okay, I'm gonna get liquidated at this price. That's the max leverage I can get, right? Um, so you basically just move one variables at the end of the game. But when you trade options, you have a lot of variables, right? You need to trade and choose the strike price, choose the expiry. You need to understand all those Greeks and so on. So that's also something very interesting to me. It's like how oversimplified was trading, even though perpetual, if you do them in a professional way, like if you talk with any professional trader or, more institutional, no one likes perpetual in the sense they're very expensive, especially when it comes to DeFi. They doesn't let you, play a lot with different variables. And when you're a professional, you like variables, right? You like to play with it. You like to find. So that's something also very interesting when it comes to option space in crypto. It seems that right now, what traders want is like something that is very, I wouldn't say basic, but like simple. Like you don't have to move a lot of leverage, a lot of variables. But with options, again, I still believe that it requires education, that it requires people to actually better understand what's going on. It requires people to, play, if that's a good term, like with options, because they have advantages that can give you similar benefit, like you can get leverage and so on. It's just a matter of people now in this space are preferring other instruments. So that's definitely the biggest challenge. How can we make options in a way where it's easy for everyone to understand. It's easy for traders to use. There is liquidity, because one thing about even perpetual is like liquidity is concentrated most of the time, especially when it comes to DeFi. So you have liquidity. But when it comes to option, there is a lot of fragmentation, a lot of instruments. So there are a lot of issues. And back to your original question, like what are the main challenges? This is definitely one, educate, make sure that people understand the advantage. That's definitely a big one.
I like totally hear you, and just to like sum up, I think everything you're saying is like one like people we just need to get smarter, which like I can say that about basically everything in this space. But two, it sounds like what you're saying is that today options just aren't sorry, crypto options just aren't capable of expressing the same views and the same positions that traditional options are. And like that's the gap that so like forget liquidity, forget education, they're just like not expressive enough. And like I think that's what you're saying, an opportunity you saw.
No, that's absolutely correct. And one thing to add on that, like what I've realized talking with traders most of the time, in crypto is always about direction. Like people trade directionality, market up or market down. There is not much more people want to trade. It's like, okay, market is gonna go up or down. Easiest there, right? Very short term. With option, you have a different dimension. You trade in volatility, right? So that's something that in this market, I don't think we're there yet. But that doesn't mean that people don't want it. It means it's just a matter of time and again education and so on. But traditional finance. Look at what happened with Robinhood and GameStop and everything. Everyone was trading options back then. It became one of the most popular instruments in the US. It's like trading options. And so again, I really believe it's a matter of time and making sure we, educate and make them appealing to this, global audience and more, average user as well.
Yeah. Yeah, cool. So let's talk about risk. You are with your buddies in the open chat, realizing like, oh, there's an opportunity to run this hackathon, maybe do some liquidity. Can you talk a little bit about like how that hackathon project turned into a protocol or a company or whatever you guys are calling it?
Yeah, yeah. The back then Open had basically a settlement layer, right? So, and this is probably gonna be very interesting when we talk about composability, but the way the protocol was built was to be composable. So the idea was everyone can create an option. So the protocol was, I wouldn't say simple because it's actually pretty complex, but was simple for anyone to create an option, right? So you can say, I want to create an option market. So I want to create an options market on it. You can use Open and you create an options market on it, right? And then you need counterparty for that trade. So you can say, I want to sell an option. You can create this option, but then you need someone to buy it, right? So you can do this in very different ways. And back then, Open had an order book system. I think it was built on top of 0x. Again, composability, right? So protocol and then 0x, another, protocol. I call it about composability. So it was an order book built on top of 0x. So to trade, you need to post a limit order, right? So you say, okay, I want to sell this option for $10, whatever. The main issue with that is when you are talking about options have expiries, you have put and calls, and you have multiple strikes, right? So if you think it this way, you have a lot of different products because each product is kind of independent, right? So to have a market that is liquid enough, you need an infrastructure in terms of traders, market makers, that it has to be huge because everyone has to post, those limit orders and so on. And back then it was on mainnet, end of 2021, gas was crazy high, everything was on chain. So it was like basically, yeah, it was like crazy. Like it's definitely like the market, like the protocol itself was great, but creating a market on top was very challenging. So one thing we wanted to do is like we can learn from other protocols like similar to Uniswap and try to create this sort of AMM, right? So the idea originally was how can we build a pool on top of this protocol where actually anyone can trade and the counterparty will be this pool and this pool gonna trade multiple product and so on. So we can concentrate all the liquidity into one single pool, like similar to what Uniswap was doing. The problem, obviously, you cannot use Uniswap with options or like traditional AMM because options are, again, very interesting instrument. They have an expiry. So if you try to see the pool like Uniswap, put in options and, let's say USDC or whatever, you're going to probably end up losing a lot of money because, when it goes to expiry, one of the two assets, like especially the options might be worth zero if it's out of the money. So, if you're selling, you're losing a lot of money. So you need to build something specific for that. So that was the original idea. I was like, okay, let's try to build this, liquidity pool similar to an AMM specifically for options. So that was like how we started out of the hackathon. And that was end of 2021. I think that the hackathon was even simpler than this. It wasn't like a real AMM or something, but let's start from, it was an hackathon. We wanted to get something done. And since then, we basically keep building the protocol. So we started to actually work like full time. I think it was February 2022, something like that. So it's like over a year now. Yeah, right before industry ended. But something that was possible back then to build something we were building, it was also because layer 2 were coming. So it wasn't even possible before because when you wanted to trade options, especially pricing options, is very like computational intensive. And so we couldn't really do that with Ethereum mainnet. Again, back to gas and everything. But we could do that with, Arbitrum or Optimism back then. And so February 2022, we already have some layer 2s there. I remember talking with Arbitrum a lot. And I was like, okay, now we can actually build this because of the infrastructure we have. And so this always reminds me like how early everything it is in this industry because again, it wouldn't be possible to build it before having layer two, just from like limitations. So again, like options market, um, there are a lot of challenges, but again, we basically started to build not even a year ago, because before there wasn't actually even possible to do it, what we're trying to do. And so, yeah, since then we've been working. We had an alpha that we launched that it was like, very basic just to test everything out. And we launched it like September last year. Yeah, September. We learned a lot. We figured it out like something that we definitely need to change. So we improved it, and then we basically released this new product that it's, on the trading competition that I was talking to you a few months ago. So it's a very slow process.
No, please. Maybe slow for crypto, but come on. You didn't have a product a year ago in traditional world. You have 4 more years before it's even a real thing.
That's true. Yeah, that's true. Like compared to Web2, it's slow. Like I'm coming for Web2, right? You don't need audit. You don't really care about like, I mean, you care about security, but not them. So it's different. Like you can really ship multiple products.
Yeah, that's incredibly interesting. This is the first moment I'm having this thought, but like, okay, so you go from like Web 1 to Web 2, and development speed like increases tremendously, right? More
Yes.
tools, more frameworks, like more just everything. And then you go from Web 2 to Web 3, and everything slows down. And it's not because there is less tooling, but it's not because of that. It's basically because we've realized that in Web 2, if you make a mistake, you literally just reboot the server. In Web3, if you make a mistake, you lose hundreds of millions of dollars. And I don't know, there's something profound in that.
It is absolutely like I remember when I was doing Webshare, we were releasing every Friday something new. And it was like easy as that. And I remember, like Friday night, you release something, you're gonna hope that everything's not gonna break because you wanna go out and drink with your friend, right? But that was the mood. But with Web3, it's absolutely the opposite. Like until you are 100% sure that you have coverage on everything tested, like you have multiple audits, you have a bug bounty out, it's like you don't release. And so it's way slower process for sure.
Yeah, interesting. I don't know. Maybe we'll talk about that more. If not, that's a good insight
Another
for the next
podcast.
episode. Okay, so now that we're like in risk, can you like help me understand what is risk as a like complete holistic system? What is like the code that you guys have built? What are like the things you're drawing in from other protocols? Like, what does the risk stack look like?
Yeah, yeah. So let me give you an idea on overall risk, right? So we have one product right now that is called Dynamic Hedging Vault. So as the name saying, it is a vault or a pool, call it whatever you want, but let's say it's this liquidity pool that we have. So this liquidity pool, on one side, we have liquidity providers, and that deposit stablecoin USDC for now, probably more in the future. So they deposit stablecoin into this pool. And this pool, as I said before, basically acts as an AMM, so a market maker for options. On the other side, we have options traders, right? And when I say traders, it's not just people. It's not just like, we don't expect like a guy trading options. We also have other protocols, and that goes back to composability. We have more, some like institutional and so on. But protocols is actually a big one. So what they do is they can trade options, and this pool, or dynamic hedging vault as we call it, DHV, is the counterparty for their trades. So let's make a simple example. Let's say I want to buy an option, a call option, 1 month expiry, strike, whatever. What you can do when you buy this option, you basically can get a quote from the DHV. So DHV is going to say, okay, if you want to buy this option, that is price I will be able to give you. And when you do the trade, as a user, you pay a premium, right? Because you're buying the option. And we use the liquidity into the DHV, so the deposited USDC from liquidity providers, we use them as collateral to mint and sell this option, right? So now there is a call option. Let's say this call option has $1,000 as collateral. We got the $1,000 from the liquidity deposited, and now the user is buying, let's say, for $100. So what happened is the liquidity pool now has exposure. So he sold one of this call option, and he collected $100 from the trader as a premium, right? So that's something very simple that is happening there. Obviously, there is also selling side. So you as a trader, you can sell the option. In this case, you collateralize the option yourself. So you're gonna put this $1,000 as collateral, and the pool is buying from you, right? So we use the deposited USDC to actually pay the premium to you, right? So how the business model is working on this. Now, there is a bid and ask, right? Or buy and sell, call it whatever you want. So let's say we buy from $100 from the first user. Like when I say we, I mean like the DHV is buying from $100 and is selling for, basically for a higher price. So it's selling for, let's say, $105, right? So what happened in this case is like the DHV collected $5. That's the spread. So basically those $5 is the amount that is going to liquidity providers because they deposited liquidity into this. So this is like a very, let's say, if the market was efficient, everything was perfect, that would be the ideal scenario, right? You have one buyer, one seller, they both trade the same option. The exposure for the pool is actually zero because one buy, one selling. You collect the spread, you make money, everyone is happy. This is like, something that would be perfect. Obviously, the reality is absolutely different because sometimes you have more buyer than seller. Sometimes you have the pool that is actually exposed towards a single instrument, right? So here comes a lot of the composability component of the DHV. Because what we build for the DHV, we have the idea that if you are one of the liquidity provider, there should be like no risk or absolutely lowest risk for them, right? That's like, if you think about a casino, that's the bank. So you don't want to, you don't want to make risk with those people. You don't want to make risk with those liquidity. That's the bank at the casino, right? So we play blackjack and you want to make sure that you get a return out of it. So let's say this is the case I told you before where everyone is buying. So the pool at this point is short and they sold a lot of calls. What happened in this case, if the price of it is going up, the pool could have a loss because when the price goes up, the call could be in the money. It means that there will be a loss for those liquidity providers. So what the Vault is doing is as a mechanism that try to hedge the position. So this hedging happens in a lot of different ways. The main one is price on those option in basically a more expensive. So we incentivize people to sell because price is high. So that's the first thing you do. Again, this works if there is an efficient market, a lot of arbitrage and so on.
Let's unpack each one of these. So what you're saying there is in the first line of defense is the sorry, what is it? The DHV?
DHV, dynamic hedging vault, yeah.
Yeah, the DHV, okay, says like, oh my God, I've just noticed I have exposure. The first thing I'm going to do is try to like eliminate that exposure by either buying or selling the opposite thing at like a discount or a premium so that like, yes, I might have to pay a little bit amount, but my exposures are netted to zero. Is that right?
Pretty much, yeah. So basically saying, we mentioned the option that it was worth $100, right? So what we do now is like we try to sell this option for 150, let's say, something like that. So if you are a seller, you're gonna be like, oh, this is a very interesting price. Let me basically sell it for, basically sell for, when I say sell, like from the trading side. So you're gonna basically sell for 150. So the vault is like, trying to do that. And so we have this mechanism where actually you reduce your exposure, but you generate money out of the volumes because that's how the DHV is making money, right? It's making money spread multiplied by volume. So if the turnover is the lowest, that's the best. So you don't want to have any inventory. So that's how we try to do as a first thing. So you create an arbitrage opportunity that is so high that someone is going to capture it, right? But again, this might not be always the case. So the other, call it like, risk management mechanism is you trade, in this case, Ethereum. So for example, if the main issue of the vault is ETH price going up, what you're going to do, you're going to long ETH, right? Because in this case, if ETH price is going up, you're going to make money or profit from ETH going up, right? So options have this concept of delta, and I'm pretty sure audience heard a lot of times about delta neutrality and stuff like that. It's sometimes a buzzword, but what you do basically, like every option has its own delta, right? Delta could be a different number. So what we do is like we check the exposure of the pool. When I say we, it's like actually an automated process there. So the pool at that time is exposed by X delta. So we basically buy Ethereum in this case for compensate that amount of delta. So we bring the exposure of the pool back to delta zero in that case. And so how do we trade it? Yeah, that's about composability. So we can trade the hit on Uniswap. So it's a fully automated process, fully permissionless and so on. It's like the pool is like, okay, our delta right now is very high. We need to rebalance delta. Let me go to Uniswap, trade, buy some ETH, for example. Or we can use other instruments as well, for example, perpetuals, as we mentioned before. Because if you want to short the market, you can basically short using a perpetual. So for example, the Volt is going to GMX, it's opening a short position, it's shorting it in that case, and we rebalance the delta of the pool, right? So at the end of the game, there is all this mechanism where, again, as a liquidity provider, the Volt is hedging for them in a way where it's trying to be close to delta zero. So that's why I was saying like delta neutral is sometimes a buzzword. For example, we don't use it because it's not delta neutral per se, because we just rebalance delta all the time it's moving. So when delta is like 0.1, 0.2, 0.3, let's say, we put it back to zero, right? And then it might go to minus 0.1 and we put it back to zero again. So it's always trying to rebalance in this delta. Obviously, hedging has a cost. So every time we hedge, we're basically reducing what could be the final profit for the liquidity providers to have lower risk. So it is not a free move, and it's risky to not risky, but it's like it's inconvenient to hedge too often, because if you hedge too often, you're gonna basically not have any returns. You just basically have a loss because you're hedging too much. So it's always like, yeah. So it's always like finding a good balance between hedging not too often, but hedging when it's the right time. And that's probably one of the, again, challenge that we have right now, and we have a quant team working on how often should we hedge and so on, because that's actually one of the critical component of such a product.
Okay, got it. And so from the again, just looking at the structure, the options that you guys are issuing and that sorry that the that Risk is issuing
DHV,
and
yeah.
yeah, are those Risk options? Are those open options? Like what are the primitives?
Yeah, so those are like, that's an evolution of the open option. So we, open wasn't deployed on Arbitrum back then. So we basically forked it in an official way, let's say. Open was aware of it and they suggested. We made some changes and we deployed to Arbitrum. So effectively still the open protocol. It's an improved open protocol because we made some changes in terms of collateral and stuff like that to be a bit more efficient. We deployed to Arbitrum. So effectively, we are still built on top of an open primitive. So when you buy an option, you buy an RC20 that is called an O token that represent the options that you're buying. And this is all the infrastructure that was built by Open. So what the DHV is trading, it's this open, basically token that was created by the Open V2 protocol.
Yeah, and so look, like the low hanging fruit on like the magic of composability is like, okay, look, like you are able to focus on building the like the part of the stack that you're interested in, like the liquidity and the rebalancing and like risk management, without having to worry about like just like this, like really basic, like fucking ERC20, like function interfaces and that kind of stuff. And so I think like there's some like really obvious reasons on like how composability like got you to where you are. But now that you are where you are and like you can look back, can you just like reflect a little bit on like, this is not an opportunity or a request for you to pick on Open at all, but like, can you just look back at your experience of developing a platform on somebody else's technology and how that like either made your experience like much easier and better, or like resulted in some challenges that you maybe didn't foresee?
Yeah, I mean, it's obviously like it's always a trade-off when you build on someone else's technology. And obviously every technology is also different. Like in the case of Open, for example, it's actually, we can say it's a settlement layer, right? So you basically don't rewrite a lot of stuff, as you said, that you don't want to rewrite. And you use something that is already tested and it was used. And one thing about composability there, other protocols were using as well, right? So for example, to give you an idea, like Ribbon, for example, was using the same one, right? So Ribbon is not on Arbitrum right now, but let's say Ribbon is going to be on Arbitrum. We can basically trade each other very easily because we're using the same stack without actually doing anything else on top of it, right? So that's one of the advantage of composability. When you have like some sort of settlement layer, let's say, that even other protocols are using, that makes the life very easy. So I think like composability, when it's also standardized, is actually very cool. It's not always the case. Most of the time it's not. But composability standardized is actually kind of the best. But one of the other case of composability, for example, as I mentioned on the edging side, right? When we edge using Uniswap or edging using GMX, right? So the building on something like that is actually always not as straightforward as you can think of. Sometimes it requires documentation that it's most of the time it's not even there because we are all trying to get fast. We all make innovation very fast. So sometimes like we build a new V3 and before we write documentation for other protocols, it takes weeks and stuff like that. Sometimes it's hard to test because that's another big issue of this space compared to when I was talking Web2. Like Web2 testing, it's easy. Like you spin off another server, you test it, whatever. Web3 testing is actually not as easy because you start testing on, it could be a mainnet fork, everything seems to work fine, but then you integrate on mainnet and everything is not fine anymore because, completely different environment. So testing is actually something that it's not there yet. So like integrating with other protocols, especially when, it also depends on liquidity, is also a bet that you're making on someone else. Like you make some integrations, it takes time. Like you have your developers, you do the audit, so there is a cost, there is a time on everything you do. And that protocol might be successful, the one that you're integrating with, or it already is. Like in our case, like, we use Uniswap, fine. But let's say you integrate with another new protocol that it seems pretty cool, and 3 months from now might be dead. And so there is also like this kind of risk on the integration. Plus, when you integrate in something that has liquidity, you are relying on their security a lot. And let's say there is an exploiter, part of your protocol might be exploited as well, right? So in our case, simple scenario, let's say that we hedge with, again, Uniswap and the pool is going to get drained. It means that what we were using, for example, in our case with Uniswap is actually a bit different because we just swap. So, we're going to get the other asset. But let's say with GMX, for example, that's a different case, right? With GMX, we still hold the position and the position might be worthless at some point. So security is definitely a very big issue. We saw many times that our protocol was drained, for example, from security, from an exploit, and all the protocols on top losing liquidity in a cascade, right? So that's definitely one big issue about integration as well. So composability, it is cool, but it's always a trade-off, I guess.
For sure. So like when you're designing these protocols, do you like look at each opportunity integration like as let me rephrase this question. So like when I think of risk, right? Like you have like risk in the middle and then you have like the bottom, right? Like this open options layer and then the top, which is like essentially the tools you use for hedging or risk management. And so like when you're talking about like the bottom layer, like, oh my God, that stuff better be locked in and like you better believe in it and you better think that like it's like the right choice. But on the top side, like let's say tomorrow you guys just for whatever reason feel like you need diversified exposure from Uniswap and so you decide to add Grail or sorry, add Camelot as a DEX that you're swapping collateral in and out of. And like, you know what? Maybe it's actually like not that big a deal if, well, let me say it's a much less big deal for risk if Camelot gets like decimated than if Open does. And so I'm wondering just like when you're constructing these systems, like how do you think about not only the integrations, but like given the integration point, how much like catastrophe can cascade through that connection.
Yeah, no, you are absolutely right. So it's not just about the catastrophe. That's one thing. The other thing is also how you design your protocol. Because when you build on something like open, you have to design your protocol in a way that is going to build on top of that. So if tomorrow you decide to switch from open to something else, it's definitely going to change a lot in terms of protocol, because you're going to use that token, you're going to use that decimals, you're going to use basically everything that you have in terms of that structure, right? And obviously every protocol has its own, like structure. So when you build on top, you make an even design decision and engineering decision that if you want to, switch over to something else, it will definitely be very expensive in terms of, again, new building and audit and so on. So on that one, it's actually one of the biggest decisions that you make. You want to make sure you don't, you make it properly, you look at all the pros and cons, you are aware of all the trade-off. But on the other case, like when you actually use other protocols, for example, to trade or get some liquidity, the way we even structure that in our case, we have a smart contract that is called edging reactor. So that's the one that we call. And actually, one of our ideal scenario, we want to have integration with as many as possible. And we say to the edging reactor, look, we need to edge 10 delta and we need to, I don't know, long it or short it, whatever. Just look at the protocol with the best price right now to do that, and let's do it, right? So that would be the ideal scenario. Like you want as many as possible, integrations with all of them, and to be smart enough to say, okay, this is the cheapest one to do this edging. Let's do it with, could be GMX, could be Perennial, could be whatever, Max or Camelot or, all those protocols. And so again, to go there obviously requires time because you have to build those integrations and everything. But in that case, it's more like some sort of like aggregator, if I can call it that way, where you just want to look at all of them, get the best price. But on the main layer, it's actually completely different because you're making a lot of strong decisions. So when you decide to build on top of something else, like this, Lego programmable money is actually very cool, but you make a lot of decisions from an engineering and design perspective that you rely on them. So it's a very big decision to make.
Yeah. Well, okay. So let me just throw this out here and react and have you react to it. But what I just kind of heard you say is that like when you're thinking about integrating other protocols into your protocol, you need to like think of it in two different categories. One is the integrations that are going to result in fundamental design decisions that are the core of your protocol, and the other are like kind of like features or add-ons or nice to have that like don't necessarily like change what you're building. And it kind of seems like what you're saying is that for the first category, like, yeah, man, you just need to be smart and you need to know what you're doing and you need to make the right decisions. But for the second category, correct me if I push back if you want, but it kind of seems what you're saying is like the solution to integrating as many protocols as possible safely is to develop your internal protocols like they're integrations, right? And like your basically proxy contract is like so hilarious to me because like except for the fact that you guys wrote it, like that to me sounds like a third party integration, you know?
Yeah. The safely thing is the key. Like what you said, it's like safely. So in our case, the due diligence there is like, is this protocol legit? It's, the liquidity. It's like we try to do some, obviously we cannot do audit for all of them, but, we look through the audit reports, we look, and because obviously you don't want to lose money on those protocols. But if there is this first step, I mean, obviously we talk with the team and everything. Again, if you have them competing at some point, it's actually good. So it's all about like getting a better price if you have, the 3 or 4 different for each one. But on the other, you're right. Like if you can do this safely, so once you have this due diligence process, then if you have more and you have this proxy contract, as you called it, that is able to find the best price, is actually good. The problem that I also see on the main layer, let's say, the layer 0, if you can call it this way, the due diligence there is actually like way higher because even when you want, for example, to whitelist new assets or, at the beginning I mentioned that we accept USDC, right? Even that decision is actually pretty big because the stable coin that you decide to accept is going to completely change, the protocol future because we went through USDC And we know what happened a few months ago with that DPEG. And yeah, it worked out well, but still we have like, is this the future? Like, do we believe USDC is going to be the big one? Maybe not. We'll see. So we're trying to see if there is, other stable coins. And this reminds me to a funny story. Like one protocol during the Luna crash was selling puts on Luna, and those puts were collateralized with USD. So USD was worth zero, Luna was for basically zero. So imagine you long those puts, you're like, oh, I made a lot of money, but that's not true because collateral is worth zero. So that was one of those cases where everyone lost. It's like people lost from holding those options and so on. So again, those decisions matters a lot because even the collateral you choose, it actually is, if you buy an option and you want to make sure you get your money if something happens, and then the collateral back that you get and is worthless because the option the peg, sorry, the stablecoin the peg is actually big issue for the protocol. So on that level, when it comes to collateral, when it comes to which protocol we use and so on, we are like absolutely like top due diligence. We try to view the long term. We try to go deep into each one because it really matters a lot. On the other ones, again, it's more like small integration. Even if we have a loss because there is an exploit, it will be limited. We're not going to lose all the users' money. The protocol itself, it could also be, it could still work potentially. You're just going to lock a loss because the protocol is insolvent. But it's not all the money.
Yeah. I have not heard that story about the Luna options, but like now that you say it, it's like it's so obviously true and so obviously happened that it's like not even worth talking about. But
I say it's a funny story, but it's actually pretty sad because everyone lost money. It's like there is no one that made money out of that.
yeah, let's be explicitly clear. Like the Luna thing was like a tragedy in the truest sense of the word, and was terrible for our industry. And like the only people that made money were like the richest fuckers in this industry, like the VCs and like the people who took profit, and like the people that lost are like the grandmas that put their money in this app that said that they would give them 20%, and all they did was put it into Anchor, and that there was nothing good that came out of like any of what happened. But anyway, with our last few minutes here, so I like just to like kind of hammer home composability and like what we're building here. So look, like I very much believe like once Rysk is like out there and has real volume and stuff, like a very large portion, if not like the majority, is going to just be in like people doing degen stuff, looking for leverage, like just whatever, like that's our industry. But like I I don't really care about that. I don't think that's interesting. Like what I find interesting is I think you said this earlier where like part of like one of the major customers that can't be served today, whether it's because they can't go to Deribit or the options like the resources today are on chain are terrible, are DAOs, right? Or any entity that exists entirely on chain. And so like something you said earlier was so powerful to me that like, okay, when you guys need risk management, like you can just easily go to GMX and just get a perp and like that nets things out. And I guess like with our final few minutes here, I would love to just like have you reflect on once we have Rysk that can provide this like deep, like meaningful options market, what does that mean for like these like incredibly huge protocol treasuries and DAO treasuries? Do you like and how do you see them engaging with this like technology or this primitive in a way that like just makes everything more realistic and more similar to what happens in TradFi?
Yeah, that's actually one of great point because when we started Risk, as you said, like you always try to have a vision on like what's gonna happen in the next 5 years or 10 years, right? And our idea was like who's gonna trade those options, and obviously if we believe on this DeFi world, the main traders is gonna be other protocols. When I say protocols, as you said, like I mean products, but I mean treasuries, DAOs, like on-chain entities, right? And so even like for example this complexity of options to me is not a big deal because I know there will be other products that try to reduce this complexity in a way that could be a very good UX or a very good product. They trade with the DHV as a counterparty, and the users that probably doesn't even know, right? It's just like they trade this product, they're trading options, they don't even know. And we already have some cases like that.
Here's a great example which doesn't exist yet, but like totally could, which is so our friend Wen Moom is like a member of Umami DAO, and they just came out with this GLP vault. And so like what the idea is you're supposed to deposit your collateral and then get like neutral exposure, no price action, but then earn APR. And like in the background, instead of doing this like really complex like perp management, like they could very simply go to Risk, buy an option, and then like all of this is happening without any of the users realizing that there's any hedging, any financial products like Risk, GMX. It does not matter. All you know is like, oh, it's delta neutral.
Yeah. Yeah. The spoiler here is that actually that's how I met Wenmoon, because we were discussing opportunities to trade with, with their product. So yeah, I mean, that's exactly, we already have some protocols trading that way. They created like principal protected instrument, simple one. They go into STETH, they get the interest from depositing into STETH, and they use the interest to buy options, right? So if the buy put and call, so if the volatility is going up, they actually became more profitable. So basically, as a depositor, you're giving away your potential interest to have higher returns if those options ended up being in the money, right? So this product, we already trade with some of them, and that's actually what is happening. In the case of treasuries and DAOs, that's when I started, I was like, oh, this is gonna be such a huge case for what we do. But then I started to talk with a lot of them. And we have a treasury itself for Risk, so I know what that meant. And people, when it comes to treasuries, especially on chain, they are extremely, I wouldn't say conservative, but like they really care about security because you don't want your treasury, drained because it's on some protocol and so on. So everyone is like, this is absolutely exciting. Like I will definitely use it in a sense where I, for example, buy puts. Let's say your treasury is ETH. You can, periodically buy some puts, basically buying an insurance. If the price of it is down, is dropping, you can still get some money. So everyone is definitely interested. Everyone is interested in structured product that can use options, but everyone is like, I need to make sure I'm 100% sure the security it's top level, because you don't want to lose the money from an exploit or something like that from your treasury. And so that's something that I guess as an industry we need to work on, like to the point where security is so good that everyone is going to be like, okay, I can trust, I'm a treasury, I can trust any protocol out there, or at least the ones that they have all the security and so on, because that's definitely something very big. But if we go to the point, because again, if we don't solve the security issue, I don't think DeFi is going to be DeFi. It's like we have bigger problems, right? Then treasuries are definitely one of the main use case, because treasuries are, as we mentioned at the beginning, like, pensions fund to me, or, they could be there where the liquidity actually is. And those are like the main use case for this type of product. And so I really believe that's going to be a very big opportunity. And again, the composability here is the key. Like you have a treasury, you want to deposit into something from your multi-sig on, you're a DAO, you have a multi-sig on safe, you have simple integration, you can deposit in a multi-sig, and that's the key of composability. And there is something like that in traditional finance at all. But again, we need to definitely work into security first.
Yeah. Yeah. Look, I mean, I think that that is what it is, right? And like we're in an industry where we can like reach the point where we've achieved security and everyone agrees that this protocol is like rock solid, and then puts in their hundreds of millions of dollars, and then Euler gets hacked, right? Like, and so you're totally right that this is just like a problem that needs to be solved, but like it's part of what growing pains are. And like long term, I don't really have any doubt that we'll get there. But I think like what I would love to like leave the audience on is this idea that you really just crystallized here at the end, is that like composability is like one of the three magic things about what we're doing here in blockchain, right? Like censorship resistance, composability, and I don't know, transparency maybe. We can decide that later. But composability means like so much more than like probably what you guys are thinking, you guys, the audience, are thinking in your head. It's not just that like Dan can build Rysk on top of Open, which includes Uniswap and like all these different products, but it also is about the composability and the integrations of like DAOs to protocols and DAOs to DAOs and protocols to, like expressive financial instruments and that kind of thing. And I just think that like one of the ways to truly like be Ethereum pilled and pilled on like what we're doing is to like take this idea of composability and then put it in your head and think like, okay, if I was just to like max this out like to a point where it's ridiculous, like what would that imply? And then like, welcome to the conversation.
Yeah, I mean that's definitely the sum up of everything. And I'm just gonna close it with a very funny story on the trading competition, like just to give you an idea of how beautiful is composability. So we had this trading competition, and one guy, he was doing an hackathon the first week of the trading comp, and he built a library for our protocol, open source Python library. And he then built something, basically like some sort of automation using another tool that is called Autonolas, basically smart contract automation. So he created his own product that he was trading during the trading competition, completely like fully automated. And he made that himself, and potentially, people can deposit into it. And this guy, I think he won some prize as well. So at the end, it was working, and he built basically that out of an hackathon, right? So that's the key of composability. Everyone with an idea using a couple of different tools can actually build another product for a very specific case. And, because I cannot even think of all those use cases, but people do. So that's definitely the beauty. And it's a small example, but I guess that's where we go in, where you can use all the other protocols, all the other tools out there, and basically build products for DAOs, so you can build specific product for a very specific type of traders, or and so on. So that's the beauty of, as you said, like this Ethereum ecosystem, and that's the reason why we're here, I guess.
Yeah, man. And again, when I reached out to you to record this podcast, like I just knew that I want to talk to you about composability because I think that's like what the interesting thing is when we're talking about these like real financial primitives. But it's just like pretty wild to, after sitting through this conversation for an hour, to realize like this composability isn't just about options, man. It's like, it's kind of your story of like how you got involved, how you got interested in Rysk, and how like you're building what you are. And so, man, I just can't wait to like continue talking to you and learning about what you're building and like how you're thinking, because again, man, I think you get it. I think there's like three ways to understand why Ethereum is magic, and like you have taught me so much more about that composability one. So thank you, my friend.
Yeah, thanks for inviting me. That was a fun one.
Of course. And before we head out, can you just tell the audience where they can find you, where they can find Rysk?
Yeah, and, you can find me pretty much on Twitter, I guess.
Hopefully, if you didn't run out of your quota.
Yeah, exactly. Now we have a quota, but I don't use it a lot for reading. No, just kidding. I hope I will be in the quota, otherwise I'm gonna pay. But yeah, you can find me on Twitter. And on regarding Rysk, basically the website is Rysk.finance, Risk with the Y. You pretty much you can find everything you need there. But just ping me if you have any questions or something you'd like to discuss about pretty much everything, options, DeFi, composability. Yeah, I love to talk about it. So that's the best way.
Awesome, man. Well, I will definitely be badgering you on all sorts of channels. And again, man, like I think you just get it in a way that most people don't, but like especially the ways that our like financialized conversation around crypto is just like so brain dead and so not informed by like real experience and real building and stuff. And so, man, I appreciate this conversation and appreciate meeting people like you. So thank you, man. And have a good one.
Thanks a lot, you too. Bye.